Good morning, members. It's LA. It is the end of September, end of the third quarter. We're moving into the fourth quarter this next week. So we'll be wrapping up the third, moving into the fourth. And as you can see here from the numbers, it was a pretty tough week. And that was despite a big rally again on Friday after another big spill. Down 1% on the Dow, down 2.4% on the Russell. Year to date, Russell almost 4% lower, and now these are starting coming down as well. I'm going to spend quite a bit of time looking at the Russell, and the reason for it is it really is kind of the canary in the coal mine. It's the one that has given us the best signals most of the time. And I know there's a lot of arguments about, the Russell, hey, it's really not maybe representative of what's going on, everything else looks fine, there's just something wrong with it. There's been, various reasonings, if you will, as to why it's doing what it's doing. The best one that I've heard, one of the members suggested, I believe, is that it's really that they can't manufacture their gains like the other indexes. In other words, they can't do the buybacks. They don't have access to the capital to do the buybacks, the loans. Maybe that's true, and if that is, maybe that's symptomatic of a larger problem, and that is that we can't grow sales, and we can't, increase the top line for the most part. It's just the bottom line. We keep squeezing more and more out of the bottom line. I'm concerned about that, and this week's action to me looks a lot like what I've seen before, and I want to kind of go through that scenario with you. So if I look at the technical picture and look at the index and review here, last week, I highlighted the Russell as probably the biggest negative along with the fast currency moves, and when I did that, I had more of a bullish bias last week, as going in thinking that we'd go back up and test those highs. Last week turned out to be a very hard read, turned out to be very wrong read. Not only did we not test those highs, we had a lot of volatility pick up and so forth. So let's look at some of these charts here that I put together for you on the Russell. The first one is just this idea that the Russell has now moved to a discount, and a fairly significant one. So all along since this bull market, as this bull market has risen higher, right, the S&P has traded at a discount to the Russell, and that's typically what you see in a bull market. Now when it matures, those things can change, and when they do change, you have to be aware of them. So the beginning of this year, if we go back to right here at the beginning, Russell still traded at a big discount, and then the Russell came off hard and almost traded at a discount when we hit those, that it wasn't the bottom. The Russell actually traded negative while the S&P started back up. Then the S&P continued and the Russell went with it and traded at a premium again. That all stopped when the Russell tested those highs and failed. That was here. You can see it better on the bar charts, but the candlestick charts. But here you can see it went up, it tested, it failed. It's kind of a double top situation in the old classical stuff, right? So that double top fades back down, right? Comes back just like it did here, fades back down. S&P, Russell both trade down, then they both trade up, and now the Russell has traded at a huge discount to the S&P. That's the first time since this bull market began, that this has happened, and that's what I wanted to show you here in the next chart. So Russell, you can see kind of this consolidation pattern up here at the highs, and it's trying to break down. While it has made a lower high now, the S&P again has made a higher high, which is why it's trading at a discount. And throughout this entire run, this situation has not occurred. Since 2009, the Russell has traded at a premium and has not failed to make a higher high. Now it's taken a while to do it at times. In particular, if you go back to here, it took a long while to do it compared to the S&P, right? The S&P did it a lot sooner than the Russell. Maybe we're in that same situation. If you look back at the dates here, we're talking about 2011, 2012. So there was this big dip, you know, big drawdown, if you will, in this time period, which is, you know, September, October 2011. And then eventually they recovered, went to new highs, Russell went to new highs, and so forth. Everything was fine. Now you have that divergence again, and that divergence, as it so happens, looks very much like what happened in 2007. This is 2007. Again, nice big strong run, big premium, all that kind of stuff, right? You didn't even trade at a discount, so that's a big difference between these two. But you did see that topping pattern where the Russell could not make a new high, whereas the S&P did, and then eventually these all sold off in a big way. Is this the same pattern? Is this the same thing happening here? You know, I don't know that that's the case, but I do know that you've got huge divergence, and even worse than what we saw in 2007, we're actually trading at a discount now. Right? The Russell is actually trading below the S&P 500, and that typically doesn't happen until a bear market's already begun. So when I look at all of that, and then I go look at the Russell itself, you know, there's this big potential, I don't know if it's big, but there's a bearish potential. It was about a 6% last week. It's actually spread on 2 pages here now. Let me just cut this so that it ends up on 1 page. This change, this was about 6% last week. Now it's only 3.5%. If it actually fulfills, in other words, if we break down and the Russell starts to do the ABCD pattern on the way down, and is right down here testing, below almost got tested. It was 1107.31. We got down to 1107.51, so we missed it by 20 cents. Got a weak bounce on Friday here, whereas the others got a, you know, well, I don't know if it's a weak bounce. This is a big price point bounce, but weak in terms of volume. It's going back up. It's going to try to test this high, the high of the low, which is what it got into. And remember, you know, I'd said last week that usually when these things get, if they get into the high volume bars, they usually try to get to the other side. This one got in pretty deep, got out, and then came right back into it and almost hit the bottom. As this bounces, you know, the first question will be is, can it get back over the high? You know, if it can't, it's in this lower range down here, and it's going to test this thing again, try to break it. If it does break it, then what we're going to see is we're going to see the ABCD, bearish ABCD come in effect, and that target on it is about 1180, right? So, excuse me, 1080. So if we go back now and we pull up the weekly chart, where does 1080 take us to? Well, it takes us down below this low, also below this low. So in other words, we're going to be breaking a swing point low here, breaking one there. That would be breaks on multiple time frames, and then it's going to go right after these and try to break those. So in other words, this ABCD pattern, the bearish one, if it plays out, right, it trades like this, and that would take it down below. Now, is it going to extend there without any kind of a rise, or is it going to bounce from there? I think the higher probability is that it probably bounces, and the reason for that is the rest of the indexes aren't going to be nearly as negative as this one. But a break of these two lows, then some sort of a test down to try to finish off the ABCD structure that bounces immediately, maybe doesn't even close below these, leaves those as potential bearish patterns to come back after once this is done. At this point, the Russell hasn't broken down. It's still in a bullish pattern. As a matter of fact, if you look at it, we haven't seen a breakdown in these indexes on the intermediate term time frame since 2012. So in other words, if we start to break here, it would be something that hasn't happened for a very long time. And to view that, let me pull the monthly chart over on the Russell. And on this particular chart, you can see it lined up here so you can see it. You can see the last time we changed was here. This was a breakout, a suspect bullish breakout. The high it broke, this is on the monthly, was 868.57. It never retested. So we conceivably could come back to do a retest regen on this at some point. In other words, that's still hanging out there and never was resolved. That price area is way back down here. But what I brought this up for, we're up here consolidating still. We haven't broken. What I brought this up for was to show you the last time we had this kind of a turmoil, maybe an inflection point setting up, and the last time we had any serious decline was way back here. And those declines in 2010 and 2011, they were significant. Top to bottom here is about 21%. If we're setting up for that kind of a move, 21%, it actually wouldn't take us that low, but it definitely would bring us down a long way if we were to get that. And they classify 20%, you know, I don't know where they get these numbers from, but they classify them as you know, bear market. Well, bear markets to me is when you start losing more money than you've been making, or you start taking drawdowns that are significant. If we take this high, you know, 12, and then take and put it back to this area, just say the top of this bar, which is 868. So 12, and I'm going to do the math right quick, minus the 868, and then divide that by the 12, that's 28%. So to get back to here from where we're at, from the highs, would be 28%. A breakdown from these lows would be about 20. So you can see it could be a significant correction if it plays out that way. And I'm not trying to spread fear or anything else. I'm just looking at what could happen. And I'm looking at it because we continue to see huge divergence, now negative, you know, price on the Russell compared to the S&P, and that topping pattern that we haven't seen since 2007. All of that makes me a lot more concerned than I usually am. And even though we don't have any breaks yet, you know, the key piece will be the break if that happens. This break, if it happens, the last time we've seen that was back here on the monthly, where this change trend transition was here. And as you can see, that was the low there, and it flipped around, went back up. This is a different pattern now. And what I'm trying to show you is that, you know, even though a break here is not the end of the world, it could be the beginning of something much more significant. And the reason for that is this has been consolidating for almost a year. We've gone nowhere in a year, right? The price point back here when we pushed into this in October of 2013 is almost exactly where we are now. There's almost no difference. The Russell has gone nowhere for a year, whereas everything else has gone up. That's a big difference. This is either a consolidation or a distribution pattern. We don't know which one. If it breaks down, then we'll know. The difference here was the breakdown came so far, right? You think of the velocity of it. The breakdown came so far straight off a high. Here you have consolidation. You don't have highs. That's a very different pattern. So if I envision this thing breaking down to here, this becomes a huge resistance on the way back up, right? Wherever it breaks down to, this consolidation becomes huge resistance. Why? You got a year worth of buyers that are underwater. That's a long period, a lot of buyers. If they go underwater, folks, they're going to sell to break even when it comes back up. That's the way it works. And that's going to be a huge problem if it happens. Let's pop over and look at some of the just the technical negatives. You know, we have, even though we got bounces on Friday, we have trend transitions now on most of these markets. If I look at the S&P 500, for example, trend transitioned. If I look, I believe, at the index, the NDX, also the trend transition, just barely. And usually, as I wrote about in one of the books, usually when this happens, you get bounces, right? Because you've come down a long way fast, and you get a bounce. The question is where does the bounce lead you? Does it lead you back to new highs, or does it not? And that really will be the the question that has to be answered in terms of whether this, what has become a large inflection point, ends up being distribution or consolidation. When I see very choppy conditions, right, many times at highs, they become inflection points, and I've said that word a few times. I usually don't talk about it because usually it doesn't happen. But an inflection point to me is the volatility increases, and what happens is both the bulls and the bears believe they're right. They both believe their view is the correct view. And that typically sets up some sort of a large consolidation or distribution. Consolidation is when you go higher after it breaks out. Distribution is where they're selling up here and it goes lower when you break out. You don't know which one it is. You can only try to read the T signals, the tea leaves and the signals that are given, and make an estimation of what it is. And and I'm making that estimation now with the Russell, saying, hey, if that thing breaks down, we know what it is. So that inflection point, it's large, it's going to be significant when it breaks. Either way, up or down. Russell is in danger of transition to intermediate term time frame. As I said, we haven't seen that since August, September, October of 2012. The other negative right now is this Russian situation. Even though it's kind of like not on the headlines anymore, there's still this tit for tat stuff going on. We're approaching winter. They control the gas and the oil that's going to Europe, or a large part of it. That's a big problem as we head towards the winter, and I suspect it's not going away because, if you think about it, Putin he's a thug, and thugs don't typically go away. They don't lose gracefully. They continue to agitate, aggravate anything they can if they do lose. And I believe that's what you're going to probably see out of Putin, who himself isn't going away anytime soon. The positives of the last week, if you look at these things, I mean, it doesn't ever seem to fail here. Let me go to the weekly. You actually had less volume as you tested lows. So that really says we could go back up and test these highs again, right before this is over. So we may see a large bounce take place and we go test the high. So I mean, that's kind of an outside shot, but those highs are still up there. And if I put it on a daily basis, you can see that high volume high, even though it was a negative bar, it did make a new high. We could go back up and test it. It's not that far away. I mean, and this is on the NDX, 40.53. That high is 41.18. Another day like yesterday, you could be right back up there again. So it's, even though it's an outside chance, it is a chance. It is window dressing into the month, right? Quarter markups, and there's a lot of data this month. So this week, so we could see an outside chance of this thing going up and testing again. Sector reviews, a lot of sectors transition, a whole bunch of them. XLF, XLK, XLY, XLP, XLU, they all transition from bullish to sideways. That usually is not a good thing. If you start seeing them transition to bearish, right, then we're going to have even more problems. And if I pop over here real quick, pull up the trends, you can see here those transitions are starting to take place on the indexes here. You got a couple of them, well, 3 of them bearish, 4 of them bearish now. So my expectation is that you're going to see the rest of them drug lower. And then the question is, do we see more action out here on the intermediate term? If one of these change, and it would be the Russell probably, to a sideways, that would be the first time in 2.5 years, and that's going to be a big deal if it happens. World markets, man, these are a mess. Remember, 3 weeks ago, everything was hitting new highs and was holding to new highs. Now you've got transitions on a lot of these indexes on the intermediate term time frames. So if I go look at, and we can pop up one or two of these, if we go look at them, you're starting to see serious breakdowns in world markets on the intermediate term time frame. And just like I talk about, if you start seeing breakdowns on the intermediate term time frame here, you'll see it migrate to the other indexes. That's also true of the world markets. If the general world markets start getting weak, most of the world markets are going to get weak. And we're starting to see that. Here's the break on Taipei. And there's a bunch of them. There's 4 of them already out of the 11 or so I watch. We've got trend transitions on the short term. So I think that there's, and actually the Canadian market has done multiple swing points on multiple time frames. So you can see all is not right with the world markets either. Moving on here, fundamentals, we got a lot of data out this week. This can drive us higher or lower depending on what they are. You got a bunch of PMIs. It's the first of the month. PMIs there. PMIs again on Wednesday and Friday. You got the ECB announcement on Thursday. So there's a lot of data. And there's also the Tankin report coming out of Japan. Japan's been the only one that's been strong. That's going to be a big report for them. So fundamentally, there's the driver, there's the potential catalyst to drive this up and retest those highs if these numbers are positive. If they're negative, to actually send us more into a spiral. Geopolitically, I talked about Russia already. The bottom line here, you can read all this, but essentially, I was pretty wrong last week in terms of my view. The reads are very hard this last week. This to me is an inflection point. To date, the bulls have won all these inflection points for a long period of time. We don't know if that's going to be the case again. We know that we're more extended now than ever. We just know that, even if that's true, if we are going to try to extend higher, the risk is high again. And when the risk is high, I believe you have to get safer. So my point here is that, I no longer think it's worth trying to capture gains at these price points. I think you're spinning your wheels, and not just you, me too, we're spinning our wheels, and we're increasing our risk in doing so. In other words, you think about it in a different way. If I put all my money on the table all the time, I'm at risk all the time. There's places where you don't want to be at risk and places where you do. There's no reason to be at risk all the time. And that's what you are if you're fully invested, right, in indexes or something. You're always at risk. And eventually, the black swan's going to come along and slap you. That's just the way it works. The whole point is to know when the risk is higher and to take shelter. And I believe now is that time. There's enough risk out here that the rewards are minimal compared to the risk. And we really shouldn't be taking so much risk. We should be heavily in cash. We should narrow down to just those core positions and stay with those, still leaning long, but a lot less long, a lot more safe. So if I flip over now to the portfolios, I just want to highlight 2 or 3. And the reason for highlighting these is, again, kind of a teaching, but also just to consider what happened last week and why we did some of the things we did. So let me pop through the only one, just a few highlights here, the only one that's still in a trading position, everything was taken out last week, that was trades. The only one I'm still holding, I thought about bringing the stops up, but that chart still looks okay. So I hate to take this out because I think there's a large potential for a big bounce if the market does okay. If the market starts to crash and burn, we're gonna lose on this position. That's just the way it is. It's a weak stock. We're playing a bottom fisher, so we may have to stop out of this, Or if we get a nice big bounce, maybe we'll just take the money. But that's the only trade I've left on. Everything else is just core positions. In talking about the only trade I left on, let's go look at some of those and why I took them out. XLY, this had come back. If you remember, this was doing a retest regen. It had come back and retested multiple times here on that prior high that it broke. It tested here, it tested again there. It looked like it was trying to regenerate higher. Then on this particular bar, it broke down. So I took and put an order in for this day, right? Any kind of a bounce, get me out, just cut my losses. We got a bounce, I got out. You know, that was the reasoning behind the trade. Okay, it failed here. What does that tell you? Well, it tells you it's in a range trade. Where could the range be this big? So why would I want to risk all the way down to here, especially when the market is starting to look weaker and weaker? Just get out, get what you can, cut your losses. If I look over at the XLF, XLF was a slightly different situation because this one had actually been a lot more bullish than the XLY. So if I look at the XLF, we had two swing point lows here. I actually had a stop in right there at those levels, and we got stopped out. Volume expanded. Yes, we got a bounce, but it does look to me like this thing's going to come back down again. You know, had we had enough confidence to stick around, we could, but you know, you get multiple swing point breaks. That's not the sort of situation you want to stay long in. I took a stop out. We lost some, but not a lot, and you know, sometimes you have to do that. The other one I want to highlight was one we still have. That's AWK. Now, AWK is the utility stock, and let me pull up the long-term view of this thing. You know, this thing has had a tremendous run, right? And we may be entering another consolidation period. We've got support down here at the 45.50 area. So 45.98 is that low, 45.43 is this. So in this area is support on a long-term basis. If we pull it in and look at it on a weekly basis, we've got this volume bar here, marked the May 12th bar. Top and bottom of that bar is in this area, right? If you take that bottom, it's right here where these lows are. You know, to me, that's kind of the key area for this on an intermediate term basis. If you look at where our stops are on this, you know, it's down in this area. You know, we're trying to give this enough room. It's a longer term holding. We may be setting up some sort of a consolidation in this area. So we want to give this a chance. All of our longs that are core, we want to give them a chance to, you know, gyrate around, consolidate if they will, and eventually break higher again. In the meantime, if we're fortunate enough to get a nice big bump up, you know, then we probably should take some profits if the market continues to look worse and worse. If the Russell resolves and we go back to the top side, well, it's a different story. But right now, that's not what we're looking at. So yes, we give it a chance, and that's what we're doing in all these positions, right? We give them room to roam around. Most of these are going to be pressured if the general market is pressured. You see that already with Google. You see the sector that G-Log is in pressured. This one's just, you know, hanging. S-Bucks, Starbucks, right? Still hanging. It's being pressured by the general market, but still hanging. Facebook is the only one that won't even go down. So that's you know, that's the only like counter trend positive in a weak market. ZLT is still holding up okay. AUK we just looked at is coming down. All of these will be pressured when the general market becomes bearish, right? Or even when it just declines into an intermediate term intermediate term bear or sideways even. Most stocks are gonna struggle. But doesn't mean you want to get out until you know it's really a bear market. What you do is you consolidate down to your core stuff. You get rid of all the other risk, right? And hold steady in a pattern. And if it makes sense at some point, you put on a short as a hedge. We're not to that point yet. That short as a hedge would be if we break intermediate term time frame and get a big bounce after that. That would be where I would look at it. But right now, we're not there. So in other words, if that consolidation on the Russell turns into a distribution, then we have to start thinking about even more protection. But we're not there yet. So what do? We skinny down to something that we can live with and take our chances. All right, a little bit long-winded here, but I really wanted to lay out the thought process and the reason I do what I do. That's where we're at. I bid you well, and I'll see you next week. Take care.